What's up, good people? Yours truly, Natasha Varela, the Money-nista. 20 years in audit, accounting, and tax. 13 as a former revenue agent in the large business and international division of yours truly, the IRS, examining large entities that report 10 million or more in gross receipts and or assets, and the high net worth individuals associated. I'm a business owner. I'm a real estate investor. I teach people through the Tax Strategies Mastermind to build wealth utilizing the United States tax code. So I want to talk about bonus depreciation. Bonus depreciation is a huge benefit in the tax code. So where did bonus depreciation come from? Prior to 2017, which is the enactment of the Tax Cuts and Jobs Act, bonus depreciation allowed new builds, right? So real estate investors via new builds to take additional depreciation in the first year the asset was placed in service. The asset being the actual property, placed in service being ready and available for rent. Okay. This meant that not only do you get your regular depreciation, which is an expense that we don't pay as investors, but you get an additional expense. Depreciation is a fancy word for expense. You get an additional expense in the first year for items such as kitchen countertops, cabinets, appliance wiring, flooring, ceiling fans, carpeting, things of that nature that have a depreciable life of under 27 and a half years or 39 years, depending on the property, right? So as of 2017, the Tax Cuts and Jobs Act extended this gift of bonus depreciation to regular real estate investors like you and I. So it's not only for new builds, it is for investors who purchase a property and intend to rent it out, okay, to tenants. So it's property that's considered new, but it's new to you. It doesn't necessarily have to be new as in prior to the Tax Cuts and Jobs Act, right? The property was considered new because the original use began with the owner. But in the Tax Cuts and Jobs Act, the original use did not begin with the owner because it was owned by someone else before you, but it's still now considered new to you. So even though it's not your original use, it's new to you. So if you purchase a property as an investment, you now can take advantage of bonus depreciation. And I'll give you an example. I had a property I purchased for rental. I'm a real estate investor. It was a total of $700,000. And then, of course, you have to take the land value out because land is not depreciable, right? And the land value was $50,000. So I had a depreciable basis of $650,000. Now, based upon bonus depreciation, I was able to get a total for the first year of depreciation, including my regular depreciation, over $140,000 in an expense. Okay. I get my regular depreciation every year, but I was able to capture additional depreciation for the first year, which made the total of $140,000 or so, a little over. Right. So if you couple that with, say, 2 or 3 properties, you can have a huge first year expense that you didn't have to pay. Okay. And you get these numbers, not because you renovated the property, you get these numbers that are allocated. So meaning you don't have to actually do renovations. You just get it because it's part of the tax code. There's an amount allocated, right? And you didn't spend it because remember with depreciation, you don't have to actually spend the money. It's allocated. I always emphasize the word allocated. So where do you get the number from? Where do you get the bonus depreciation from? You get it from a cost segregation study. What is a cost segregation study? It's a study that segregates the cost of the items. Simple, right? So you have your structure, which is your regular depreciation, right? And for properties with 4 units and under, your useful life is 27 and a half years. For 5 units or more, it's considered commercial. And if you're in Airbnb or short-term rental, it's considered commercial. It's 39 years, right? So for my case, it was $650,000 divided by 27 and a half. I got about $23,000 or so every year for depreciation for 27 and a half years. But I got an additional amount, okay, that totaled out $143,000 total for all depreciation for the first year. Okay, you do get it only for the first year. If you have not taken it and you meet bonus depreciation eligibility criteria, you can capture it on a current year return. You just need what we call a change of accounting form so that you can tell the tax return and an examiner or the tax code that, hey, I never took it, I'm taking it now, okay? And you do need a bonus, a cost segregation study. The cost segregation study gives you the amounts that are allocated to the items, and the items are determined in the study. You do not assign titles. You do not say washer and dryer or things of that nature. The cost segregation study will have the actual titles for you. You just have to plug them in if you're doing your own return, or your preparer has to plug them in. Okay. And these are items that are, again, they have a depreciable life of way less than your structure, which is in my case, 27 and a half years. These are items that are under 20 years. So 5-year items and 15-year items. Okay. 5-year items are considered your appliances, your appliance wiring, your kitchen cabinets, your removable flooring, as I said, your ceiling fans, your fixtures, things of that nature. 15-year items are considered your driveway, your walks, your fencing. Okay, your roof is not included because that has a useful life of 20 years or more. Okay, so you can't expense that. That's not part of the cost segregation studies. Therefore, it's not part of your bonus depreciation. You do not include anything else in the cost segregation study. It is done for you based upon your purchase price minus your land value. Okay. I get a lot of students that tell me, well, I purchased a new washer and dryer. I did my deck over. It doesn't matter. The cost is allocated for you based upon your purchase price minus your land value. Whatever you do outside of that, that is something separate. If you did the roof over, there's no expense. That's just something that you did, and it goes into the cost basis of your house. Hopefully you recoup when you sell, if you do sell. If not, it's just what it is, right? Now, bonus depreciation works for buy and hold, okay? If you sell your property, you're going to have to pay back not only your regular depreciation, but bonus depreciation. So if you're in the Tax Strategies Mastermind, you know that we're all about buy and hold. Otherwise, we don't take bonus depreciation. Now, if you do want to unload the property, the options are to do a 1031 exchange, which means you roll the property over into another property of equal or greater value. This way, you do not have to pay back any of the depreciation or bonus depreciation. And that requires you to have an intermediary, meaning the funds can never hit your account. The sale of one property, the funds go into this escrow. The escrow then goes into the sale of the purchase of the new property. Okay. Now, another strategy is if you have a property that you need to unload because it's just creating so much loss, then you can sell your property to gain and offset the gain with the loss. But just buying and unloading later is not a strategy if you're going to use bonus depreciation. Now, bonus depreciation is great, even though it's only for the first year. The reason being is it creates a huge phantom loss, right? We don't pay the bonus depreciation. We don't pay regular depreciation. It's just a gift as an investor because the tax code loves real estate investing and business activities. And it gives us this reward, right? You don't pay it. It creates this huge phantom loss. So you can have a real profit in your rentals, but the tax code gave you depreciation to offset that profit. And if you couple it with real estate professional status, if you haven't looked at my videos, go ahead and go back and look at real estate professional status for long-term rentals. That loss can offset all of your ordinary income, your W-2, your 1099, your business income, retirement income, whatever have you. If not, if it's a short-term rental, you have different rules. Please go back and look at my short-term rental video. It can act the same way because you still get bonus depreciation. Okay. For my business owners, if you have large machinery or equipment like tractor trailers, cranes, or whatever have you, whatever your business is, you have large equipment, bonus depreciation also applies. It's just you don't need a cost segregation study. Okay. That's done. We teach how to do that in the Tax Strategies Mastermind. It's based upon the cost of the property and the machinery, tools, or equipment, okay, because it's considered eligible for bonus depreciation. And you get the same benefit, create these huge phantom losses and still get to keep the profits in your business. Okay. Now, there are some criteria where somebody's not eligible for bonus depreciation. And this is specifically not only limited to, but I want to talk about my real estate folks. If you inherited property, you cannot take bonus depreciation. If you purchase property from a related party, you cannot take bonus depreciation. What's a related party? A related party is your mom and dad, grandma, grandpa, kids, grandkids, okay, and siblings. Everybody else doesn't count. Aunts, uncles, those don't count. But from your related parties, you cannot take bonus depreciation. Also, you cannot have used the property prior to acquiring it. So if you lived in the property and you're doing a rent-to-own situation, you've used the property prior to purchasing it, so you're not eligible for bonus depreciation. There are several others, but those are the two main that apply to people that they need to know about. The related party / inheritance, and using the property for personal use prior to acquiring it. Okay, so bonus depreciation is a wonderful thing. There is a bill on the table to extend bonus depreciation 100%. Every year it goes down. So from September 27th, 2017 to December 31st, 2022, you get 100% of the cost allocated to these items as an expense. Starting January 1, 2023, you get 80%. January 1, 2024, you get 60%. 2025, January 1, you get 40%. And then 20% for 2026, and then it phases out to 0 for 2027. There is a bill on the table to extend a 100% bonus depreciation retroactively from January 1, 2023 to December 31st, 2025. Hopefully this occurs. This will give investors a huge advantage to offset their tax liability if they couple it with real estate professional status or short-term rentals. Again, if you want to learn how to utilize these losses from real estate to offset your tax liability, go ahead and visit my other videos. You can join the Tax Strategies Mastermind by visiting www.themoneynista.com, or you can enroll in my free live training. Until then, happy wealth building.